Yeah, like our friend back there, Joel, 17 years with Anaco, but 30, this is my 32nd year in the business. And yeah, Joel, I remember no cell phones, no pagers, no laptops, no internet. Back in the prehistoric days, we had fax machines. We even did that really odd face-to-face thing where we went out door to door and met with clients. But yeah, it worked, didn't it, Joel?
Yes.
It worked. It still works. So face-to-face contact, eye-to-eye contact, still works. But together, Anaco and FEG, we've been at it as a team or a partnership since 2013. So going strong. And going so strong that our life premium in that 5-year span, now going on 6, over 130% growth. So you folks, and then the annuity, unbelievable. That's why Jim and Paul at FEG, their new guy, says, oh, Anaco doesn't want annuity business. Like, heck we don't. We're growing with you folks over 1,500% a year. And I know we've got somebody in here. Joel just walked out, but hey, Joel?
Joel.
Yeah. I know we've got somebody we need to recognize tonight that's got a large annuity case.
Yeah, Jeff.
Who do we have to recognize that's going to make up part of that annuity growth in 2019?
Well, we got somebody.
Or am I jumping the gun?
No.
Okay.
Tina, come here. We just confirmed today. Jeff would like to recognize you, Tina. Yep. So we just confirmed today that that check of $1 million was just overnight to Anaco. Oh. That's one case. That's just one case.
Woo! Thank you for that. Some of the things that are new, and I'm going to kind of jump around a little bit tonight. I know we've got some people that haven't seen some of the things that I've talked about. We have some that have, so I've got a little bit of new, a little bit of old, a little in between. So I'm going to jump around a little bit. We're going to finish up, though, really kind of drilling into IUL. And that's where I kind of want to make the focus as we finish out the evening. But for starters, some of the highlights, we increased our retention, okay? And I'll kind of cover that in the next slide. Smart underwriting. I'll talk more about what that entails. It's more than just high IQ with the underwriters, okay? Actual, I'll get into it and what that means for you and your business. Precision credit underwriting, where we can really get more precise and utilize some of the healthy markers that clients have to offset some of the unhealthy markers that they have. Lower cost, lower term premiums, lower GUL premiums, okay? Let's start with the retention. We increased our retention through age 75 up to $5 million, okay? That's all products. Term, GUL, IUL. What does that mean? Well, we're an insurance company, but on those larger risks, we insure those larger risks. We don't want to be selling a lot of, $50 and $100 million life insurance policies, because if we have 1 or 2 death claims, half a dozen of those policies with death claims, you got to pay out some big dollars. So insurance companies have insurance companies. Reinsurance. We insure those high risk losses or those high amounts with reinsurance. But we have to pay a premium. Just like if you had a health insurance policy or your auto insurance, let's say auto insurance, and you can either buy a $100 deductible on your comprehensive, or you can buy a $1,000 deductible. But if you buy a $100 deductible, the premium is going to be about 2 to 3 times what it would be for a $1,000. Same principle applies. We raised our deductibles. We now retain up to $5 million through age 80, up to $2 million. Used to be about $500,000 on those small cases, older ages. In fact, it was $500,000 across the board. And then we raised it up last year to $1.5 million, now to $5 million. So That means our costs go down, we have more control on the underwriting, so some of these larger cases that you do write, $500,000 and above, $1 million, $2 million, $3 million, or $5 million even, they're all staying at Aneco. We don't have to get a reinsurer to underwrite it, we underwrite it. So it means you get better underwriting, quicker underwriting. And speaking of quicker underwriting, we continue to evolve in our accelerated underwriting program. We added the Express Plus last year. Okay? So we have 2 tiers of Express underwriting. We have Express, which covers up through $249,999. That's through age 65. 80% of those cases are being approved non-med. Okay, 80%. Then from 250,000 up to $1 million, that's through age 50, or I'm now in the next age category, but age 51 to 60, I'm not going to tell you where I fall in there. 51 to 60, we have Express Plus, that goes up to $500,000. And there we're getting about 40–45% non-med approval. Okay? A lot of companies, the average on their non-med programs like that are somewhere in the neighborhood of 20–30% approval rate. So we're higher than what they are. Okay, let's talk about smart underwriting. Okay, it's not just a room full of smart underwriters, it's actually AI, okay, artificial intelligence. We use Watson, you've heard of Watson, IBM. We use him, he works for Aneco now. He's in our Life New Business team, okay? He's got his own desk and everything. But we have AI for underwriting. Any case through $249,999 through age 65, basically any express case that comes in Expert App, within 12 to 24 hours, they say 24 to 48, but we're actually running about 12 to 24 hours. They run the MIB, Medical Insurance Bureau, RX database, that's prescription drugs, and Department of Motor Vehicle. They run those. If all the other stuff on the application checks out, health question-wise, nothing else crops up, they're approved and issued within 24 hours. Just like that. And we're paying commissions daily. So your cases go through quicker. We had 38% approved on smart underwriting in just the last few months. That's the latest statistics. That was in the home office in January. So that's pretty impressive. We got a mention in one of the industry publications in January, Brokers World. So they were touting Aneco's progressive underwriting. Okay, precision underwriting. Now that we're talking progressive. Table 6, we used to go out as far as Table 4 on our Guarantee UL only. All other products, we went out to Table 2 and did some precision underwriting. Well, now with the increased flexibility that we got with our higher retention limits, we now will go out to Table 6 or better, and on those cases, we will try to shave anywhere up to 4 tables off the rating. So if you've got a case that's Table 4, we might very easily be able to bring it back to standard. If you have a case as bad as Table 6, you might be able to bring it down to a Table 2. That covers a wide area, 30, 40 different medical situations, medical histories, occupation ratings, you name it. Okay? There's only a few exceptions. It doesn't cover smokers, and there are a few conditions, some of them cancer-related, and type 1 diabetes with complications that are exceptions. But a majority of those difficult, type 2 diabetes, obesity, sleep apnea, anxiety, you name it, those are the things that they can do some precision underwriting on. Okay, lower premiums. We continually reprice our term, our signature term, about every 2 to 3 years. A lot of companies, they get pretty competitive and then they don't do anything with their term portfolio for a while. And just like anything else, it falls out of favor. The price, somebody else comes along and they beat them on price. And pretty soon somebody else comes along. Well, Aneco is very staunch about remaining competitive. So the minute we got wind that a few of the other FEG carriers were starting to look at repricing their term, And we went ahead and did it too. And we undercut them. And everybody else. We got some of the best term out there. Minimum face amount did increase to 100,000. It used to be 50,000. But that allowed us to do these price cuts. Highly competitive ART and 30-year. We were already number 1, number 2 in the industry, so we didn't have to change the pricing on that. But on the 10, 15, and 20-year term, you are seeing some price cuts. This is November 1 of last year, as much as 30% plus reduction. Very, very cheap. Okay? So give you an idea of kind of how we stack up with some of the big competitors out there on term. Male age 35, 45, 55, number 1, and there's some of the bigger competitors out there. And then the other thing you got to throw in the mix when you're looking at comparing term is not just the price, because there's always going to be an internet term or somebody else out there that's going to promise a better price, but it's the total package. Because sometimes their best available price term doesn't have conversion options. You want conversion? You got to pay a little bit more. That's an add-on. Oh, living benefits? That's an add-on. By the time you do all those add-ons, those other term plans aren't nearly as competitive. So when you look at Anacle's total package on term, you've got very competitive pricing. You've got term-to-term conversions. Now, how many have not heard of Anacle's term-to-term conversion? Okay? Usually, and the word conversion, if you're newer, conversion means no new underwriting, no new application, no health questions. It's guaranteed. So if they have a term with Anacle now, it's guaranteed convertible up to either another term policy or a permanent policy. Now for the term-to-term conversion, that's only if it's an ART, annual renewable term. But they can convert in the first 3 years to a 20 or 30-year term with no new underwriting, but we do pay brand new commission. Okay? They can convert anytime in the first 10 years from that ART to any permanent plan. Again, no underwriting. Okay? Any of the other level term plans we offer, the 10, 15, 20, and 30 year, they've got the full level premium period to convert without health questions or underwriting to any permanent plan we offer. Okay? Up to the earlier of age 65 or that full level premium guarantee period. And again, we pay for full commission. So, pardon? If they have riders on the term and they convert it, yeah. Like if they have a child's term rider, the other rider we have on term is disability. Those would convert over to the new policy. Okay. If they do any conversions to permanent in the first 5 years, we do spot the policyholder with a credit. Whatever premium they paid that year on the term policy is going to be considered paid into the new permanent plan. They don't have to pay that twice. So if they paid the full annual term premium that year, we credit that full annual term premium.
So if they paid 9 months,
Then we would credit 9 months towards that new permanent policy. A lot of companies, they don't do those conversion credits anymore. That's old school stuff that when Joel and I got started in business, you saw conversion credits. But you don't see that today so much. Isn't that so common? Okay, GUL. Our Guarantee UL, still one of the best Guarantee ULs out there for both price, and now especially for price, and for the guaranteed cash out. Okay, price. We were already pretty competitive in the younger age market up to about age 50. We repriced, even shaved a little bit more off of that age 40 to 59 category, another 10% off. In the millennial group there, 18 to 39, we shaved 5% off of them. So the millennials are happy, the Gen Xers are happy, the baby boomers are happy, we knocked 20% off of them. And then, I guess still baby boomers, so 10% off 71 to 80. So bottom line, anywhere from 5 to 20% reduction on our GUL. We now have, we're number 1, number 2 in the industry on GUL on pricing. And then you put together that with the guaranteed cash out, and we've got the best cash out, which means return a premium, they can cash out the policy, and the best pricing. Far above the major competitors in the GUL marketplace, okay? So those are kind of the highlights, but again, we're gonna really focus tonight on IUL. And it's kind of like a puzzle, all right? The pieces fit, get everything in place for each client, so we're gonna custom design the IUL. Every client's gonna need something different for their IUL. Okay, I indicate my in-laws are in town. My mother-in-law is a avid puzzler. We had to go out and buy like 3 puzzles. She's already knocked out 2 of them. So that's what gave me the idea. So I got this slide out of an old presentation in honor of my mother-in-law, the puzzler. Because our clients, I actually took this out of a pension presentation and then I adapted it. You know, does the client need flexibility? Are they more focused on long-term protection, maximum accumulation, lowest cost? What are some of the hot buttons? And once we know what their hot buttons are, then again, we can custom design and we can make sure that we hit those points when we're presenting the IUL to that client, because it's got to be a personalized, customized plan. So why Anico for IUL? What are some of the things that we offer? Okay? Well, for starters, we have two options, but again, my focus is going to be on Signature IUL, so I'm not going to touch on that one so much. Signature IUL, 4 simple S&P options. Second bullet point. That's key. Why S&P? Because everybody in this room has probably heard of the S&P 500. Most of your clients, when you say S&P 500, they've heard of it. Oh yeah, it went up about 20 points today. You know, you hear some of these other proprietary indexes or other asset classes, you say, well, what did the real estate index do today? I have no idea. You know, what about the Barclays this or that? I have no idea. I don't know what's in that. I know it's in the S&P, Coke, Procter & Gamble, Colgate, Palmolive, Exxon, you name it, all right? So we use very simple, and that keeps our costs down, and we can basically hit every type of market. Immediate, zero wash, fixed loans, day one, I'll cover that. Face reductions at any time without a penalty. 1035s with outstanding loans, and the best living benefits in the industry, and getting even better. And then one of the strongest guarantees of any IUL in the industry. Regardless of actual performance, we have an underlying contractual Anico guarantee, 2.5% lifetime. Okay? They'll never get less than that. Chances are they'll get a lot greater than that, but never less. Now we're going to drill into each of the actual strategies. Make sure you understand how they work and show you what the actual track record's been. Not hypothetical, but what we've actually paid. This is going back to 2013. So the highest, this is the fixed account. So this is easy. There's no shell game here. If the market goes up, they're going to get 4%. If the market doesn't do anything, they're going to get 4%. If the market goes down, they're going to get 4%. It's a fixed account. Most fixed accounts on IULs or most fixed universal lives are getting somewhere in the neighborhood of 2 to 3%. It's unheard of to see a company paying 4% in a fixed account. We got about the highest out there. It's only varied 1.5% in nearly 6 years, and the annualized return since the product inception is 4.38%. Not a bad option for our clients that are getting closer to maybe needing to take money out of the policy, and they need to have a sure bet every year that they're going to have at least one of the strategies firing positive. So keep that in mind. As they're getting closer to just distribution from the IUL policy loans, they might want to start to up their allocation to the fixed account. Okay, part of that customization. Okay, specified rate strategy. This is almost as good as a fixed account. I like this one because this one, 2 out of 3 market scenarios, the client's going to get that specified rate. And that specified rate is 7.5, and it's always been 7.5. Since the day the product came out, nearly 6 years ago, it was 7.5. It's the only strategy we offer that we've never had to change it. They never raised it or lowered it, it's always been 7.5. If the market goes up in any amount, doesn't matter if it goes up 10%, they get 7.5. The market doesn't do anything, they still get 7.5. If the market falls into the red, they get 0. They don't lose any money. So 2 out of 3, they're gonna get 7.5. Pretty straightforward. Oh, and that one is annualized over 5.5%. And it's got about an 75 to 80% correlation to the S&P. That fancy speak, what that means is the S&P on a rolling 10-year average is going to be up 8 out of 10 years, going back to its inception. Roughly about 7 to 8 out of 10 years, it's going to be up. So that means this strategy, 7 to 8 years out of 10, is going to give them 7.5, better than any other indexing strategy out there. So together with a fixed account, you've got 2 great ways to make sure your client gets a decent return every year. Now, if they want to try to hit a little bit higher, and they're not, they don't want to take a loss, they're in an IUL, they have to worry about taking a loss. The market goes down, they'll get 0, but if it goes up, they can capture as much as 11%. That's a lot higher than 7.5. That's capped with a 0 floor. Now that's varied 3% in the last 6 years. So it's been up as high as 14, down as low as it is right now. It's at the all-time low. Okay? It's annualized nearly 8%. We've actually credited on policies in force over the last 6 years about 8% on an annualized basis with that strategy. Not bad, you can get 8% with no market risk and no taxation. Now, this is volatility control. Market goes up, they're going to get up as high as 8%. Market goes down, they're going to get 1.5%. Market goes sideways, they're going to get whatever the market does. But they're never going to get a 0. Okay? So this and the fixed account are the only 2 strategies that guarantee never a 0. Okay? Contractual guarantee, 1.5% is the worst they're ever going to do. And that thing's annualized nearly 7% in the last 6 years, 5, 6 years. Not bad. The last one is the go-go. I don't want any caps. I want as much as the market goes. And the market, in this particular strategy, the highest we've ever locked in a given year, and it was about 3 years ago, 24.5% was the annualized return over 12 months. And that was about 3 years ago. This is uncapped with a spread. That means that on the first sliver, in this case it's about 4.75, that first little bit of return on the S&P, the client does not get. That's the break-even area. Anico keeps the first 4.75. Above that, there is no cap. Market could go up 15, 20, 25, 30. Keep going. Client keeps it. Okay? Keeps it. Everything above that spread. Okay, now I keep talking about the S&P, and I'm definitely not trying to take shots at any particular company or other indices that they use. I just know there's a lot of them out there. Okay? A lot of them out there. And people say, well, why don't you always just stick to the S&P? You do it on your annuity, you do it on your life insurance. Well, economy loves scale. Okay? It means low cost. But we also love consistency. And nothing's more consistent than the S&P 500 when you look at it. And I'm a numbers guy. Okay? So going back 1 year, this is as of the end of 2018. Going back 1 year. Here's the S&P in blue, then we got real estate in red, gold in green, and commodities in purple. Okay? So, market down as of the end of December. Real estate down about, maybe slightly less, but almost the same. Gold also down, not down as much, and then commodities way down. Okay? But as an asset class, S&P didn't do too bad, okay? 3 years, 5 years, 10 years. We start looking out long term, as an asset class, the S&P outperforms all of them. Okay, outperforms all of them. And that's what we're in for. We're in for the long haul. We're not buying IUL policies for a 1 year, 2 year performance. We're looking long term, and long term, the performance is there. Okay. Now we have this in the illustration. If you run Anaco's IUL ledger, this is about 2/3 of the way into the illustration. This is a great selling sheet. Use it with your clients. Now I can't even read these numbers and I'm up close, so that's why I extrapolated what's down here and put it up here, big print. Okay? In fact, I can even read without my glasses. That's pretty good. Okay, this is 1998 to 2017. Now, obviously, our policy and virtually no other IUL was out that long ago, right? We were just getting into the index world. I know Joel probably remembers it. Jim probably remembers it. We were getting into indexed annuities back in the 90s. That was just brand new, but no index life yet. But if we had our strategies in place with the current caps and whatever strategies, and we assume that they were in place, and we apply them against the S&P, we go back 30 years, because this is how we actually come up with our illustrated rate. We do a 30-year look back with our strategies, and we actually put that in here and show the client. S&P the last 30 years, our strategies using the present day cap that we're offering you today when you look at this policy, here's how they would have performed. Specified rate strategy, 5.19. Dead even with the S&P. It's a tie over the last 30 years. The other three indexing strategies, hands down, we beat the S&P. We beat the S&P with no market risk. We beat the S&P with no taxation each year on the returns. I mean, what's not to like? And then the living benefits, and the story just gets better and better. Bottom line is, we beat the market risk with no market risk and tax efficiency. Every strategy beat the S&P. Now, if something really happens bad in the policy, a lot of companies, they put all their energy into their indexes and their caps and other bells and whistles. But when it comes to guarantees, well, if you want a guarantee, buy a whole life. If you want a guarantee, buy a GUL. We don't have a lot of guarantees in our IUL. We keep that pretty slim and trim so we can really, launch with a lot of projections. Well, Anaco, we say we want to have a strong performing policy, and we do, but we also want to give the client one of the best guarantees in the industry. No matter what happens, your client will never get, and this is taken from the illustration, okay? Right in the back, last 2 pages of the illustration, cumulative rate guarantee. It says, policy interest rate guarantee of 2.5% had been credited for the entire duration of the policy. So bottom line is, this ledger that we show assumes that worst case scenario, none of the indexing came to fruition. Your client got no S&P returns, the market was flat or down every year. It was just a calamity for 30 years. And Anaco says, that's fine, 2.5%. This is just on a 40-year-old standard policy, $250,000 face amount. Nothing fancy. This policy runs on the policy guarantees at 2.5% interest for 35 years. Nobody else can touch that. None of them. Not even the best IUL companies out there. On non-guaranteed, basically that means using our current cost of insurance. We've never reverted to our guaranteed maximum cost of insurance, which is what the middle column is based on. But by law, we have to show that. But we've never charged the guarantee, but we have to show it. The policy runs 35 years on the guarantees. It runs 45 years on the actual, what we're actually charging. So, can't touch us when it comes to guarantees. Anaco's IUL's got the best guarantees out there. Okay. Tax-free income. That's what it's all about. We're talking about policy loans. 2 ways you can do it with Anaco. We've got the fixed loan. Okay, think about like when you borrow money from a bank. You get your statement every month, shows what the principal loan balance is, and then the interest on that loan. right? Well, Aneco does a little bit differently. The money does come out of the policy, and we put it into basically a double account. A loan collateral interest account, where we charge 6% interest at the end of the year, and a loan collateral account, where we also credit 6% interest. So if they decide, hey, I want to pay back the loan, or I want to pay back the interest, they can do that, but they're under no obligation to do that. Now, they will get a letter, and the letter will tell them what the cumulative interest is. It's on their annual statement, and it'll tell them what the current interest rate is, and what, for the 12 months going forward. And it says you're under no obligation, but you may want to, and we can set up a payment plan. I think it's $10 a month is one of the letters I saw. They're standardized letters. But just tell your client, you're going to get a letter every year, because by law, we have to issue those letters. Anytime we're charging interest on a loan, we got to disclose that. But they're under no obligation, like they would be with a bank or a credit card, to make a payment. If they do make a payment, and they pay back the principal plus interest, then that full amount goes back into the policy. If they pay back just the interest, then that $6,000 of interest that we credited is put back into the policy. Zero wash day one. Most companies don't have zero wash loans or 0% net interest loans available until outside the surrender charge period, which is 10 or 15 years. We do it immediately. So this is a very easy, safe way to take a loan and not worry about what happens in interest rates. Because we're not talking about a variable rate, we're talking about a fixed rate. But variable rates aren't a bad thing, because right now they're low. Variable interest rates, relative to where they've been in the past, are pretty low. We're at 4.6 currently. So if your client could borrow $100,000 like they did on that fixed loan, and they pay 4.6% interest on that loan, but instead of just getting a fixed interest credited to it like in a fixed loan, here the money is staying in the policy. We're not pulling it out, putting it into a separate account. It's a participating loan. They're going to continue to earn interest based on the S&P strategies that they select. So they could very easily outdo a 4.6% loan cost. Maybe they'll credit 10% interest with index gains that year. Maybe they cap out a couple of the strategies. Well, that means they actually earned 5.4% on the funds they borrowed. So in this $100,000 that they borrowed and paid 4.6, if they earned 10% on that, and the cost of that money was 4.6, they netted a 5.4%. That's positive arbitrage. Not the dangerous kind you hear about in the stock market, where you've got market risk, because here there's no market risk. Okay? There's no obligation to pay. It's not a margin loan. That's where the arbitrage people get in trouble in the stock market. Because with margin loans, those can get called, and you've got to pay them back, plus interest. Here, there is no margin loan. There's no obligation to pay it back. If they earn more than what they paid interest on, they made money. If they earn less, they have a net cost. But it's their own money. They're not borrowing money from a broker or a bank. Now, let's talk about a nuance of policy loans, though. Something that no other company does with policy loans. We'll let them take out a policy loan in the first year before there's any cash value. Now, how do we do that? Well, because the cash value comes to us via a 1035 transfer. Okay, 1035 transfer with an outstanding loan. Most companies, if a client comes to them and they want to do 1035 exchange, which means a tax-free transfer of another policy over to Aneco, they can't have any loans. The other companies say you got to pay out the loan, and then we will transfer over the surrender value. They only transfer surrender value. Aneco says, no, we'll transfer the full accumulation value over, and the outstanding loan, you decide whether you want that to be a variable loan with Aneco or a fixed loan, your decision. We actually will assume that loan with the other company we will write a check to the other company to cover that loan. Not literally, but that's essentially what's happening. We're covering that loan. So if the client has $100,000, like they do in this case, they have $100,000 cash accumulation value, but they've got a $50,000 outstanding loan. Aneco will cover that loan with company XYZ, and we will take the full $100,000 over to Aneco, and then we will put that $50,000 into either a fixed or variable loan of the client's choosing. So here's an example. This is a client age 50. You know, maybe they've got an old whole life policy and they do this. And it's very easy for you to show this. And if you're gonna show it, always do it added to the modal premium. So that way, you know, two reasons you wanna do that. If you got a client that's doing a 1035 transfer, whether they have a loan or not, don't let them get off the hook and not pay premium at the outset. You wanna program them right off the bat with a systematic premium. They don't buy something unless they're spending money on it, right? So if you give something to them, they don't feel, and then a year comes around and you go, now we gotta set up that bank draft, and all of a sudden they go, oh, wait a minute, I didn't realize I was gonna have to pay that much premium. Get them now and get them to commit to, and it should be pretty easy with a 1035 transfer, commit to. In this case, I did target premium. I got this client program to pay that target premium every year, starting even the first year. Now, in the first year, it's going to show as, you know, we said $50,000 loan. Well, it shows $39,619 because why? Because I'm paying premium, so I'm actually reducing the loan balance. Then, year 2, year 3, year 4, and then continues. I'm paying premium every year. So my client is already in the mode of paying premium. They got the bank draft set up day 1. And the values look better. You know, if they're paying premium every year, the values look better. And then I skipped ahead a few pages in the illustration, but, you know, this particular one, I showed them paying for 20 years. And then after 20 years, when they stopped paying, you know, I did option B death benefit. You almost always want to do option B unless they're really getting older. And then when they stopped paying premium, and they switched to taking premium, taking money out, then you switch to option A. Okay, we'll talk about A and B. And that's all I did, but look at that. $25,000. I'm taking out double what I paid in premium for 20 years. I'm taking it out for income. This is age 121. I started taking it at age 70 in this illustration. So I paid target premium for 20 years, and I took out double the target premium for about the next 51 years. That's the power of IUL. That's what you can do with an IUL. And I use very conservative assumptions. The interest rate on a variable loan is 4.6, so I charge them 5.6. I always pad it 1 point above where the variable loan rate is. And the max loan said that I could take out about $31,000, so I rolled it back to $25,000. Always roll back the loan amount to a safe. That way, you know, you're not going to overpromise and underdeliver, or you'll have a lot less chance of that happening. But you can really structure some nice IULs with 1035 transfers or without 1035s, with or without a loan. But we're the only company that will do it with a loan. This is the policy service form where you request a loan. If this is a case where they had a 1035 coming over and they had a loan that they wanted to categorize, they can decide, fixed loan or variable loan. It's that easy. One additional page with the policy. Okay. Here's a copy of what that letter looks like when they have an outstanding loan. So it's not a mystery. Effective October 1, the adjustable interest rate, this is on a variable loan letter, being charged on your outstanding loan will change to 4.3. In order to protect your policy value, possibility of future overloan condition, so forth and so on, you may want to, not you have to, you may wish to set up regular loan repayments. We can bill you, can. We are not billing you, we're not requiring payment. You may, we can. That's the important keywords in that letter. Make sure the client knows they'll get a letter every year, and they may say, oh yeah, I do want to say, I want to pay the interest every year. Let the loan roll, but I just want to pay the interest every year. they can do that. Okay, now option A or option B. A lot of mystery behind why we would do A or B. Okay? Okay, A is a specified death benefit amount. Okay, just the death benefit. It's independent of the cash value. The cash value growing in the policy is not paid out as part of the death benefit. Okay, if it's a $500,000 policy, doesn't matter what the cash value is at death. What are we going to pay for a death benefit? $500,000. If it's a living benefit claim, we're going to look at the $500,000 death benefit, but we're actually going to also look at the cash value. Okay, and that will actually help accelerate, increase the amount that we could accelerate in that payout. And I'll go over that a little bit later. But bottom line, A is a level specified death benefit. They're only going to get that specified amount at death. If we do a living benefits claim, we're only accelerating that level $500,000, whatever that base amount is. Option B, every year the cash accumulation value grows, we add that on top of that specified death benefit amount. So if it is a $500,000 death benefit, but it's option B, every year the cash value grows, that $500,000 death benefit grows. Okay? So when would we use one versus the other? Well, option A. The maximum premium, this is more for your information. The maximum premium, if you're solving for maximum premium on a death benefit, given death benefit, under option A, that maximum premium is going to be a lot closer to commissionable or target premium. So there'll be a lot less overfunding in the option A death benefit. Now, that means you've also got less flexibility, bullet point number 2, for increasing that premium down the road. If you're already at max premium and you're on an option A death benefit, they're not going to be able to do much in the way of increases down the road unless they request an increased death benefit, which means more underwriting. So keep that in mind. If your client is going to want the flexibility that Universal Life is known for, option B in most cases is the way you want to go. I'm introducing both of them because there are situations where you're going to want to do option A. Okay? Now, someone that's in maybe their mid-50s, 60s, just starting out, they don't have a 1035 rollover to come in, they're just starting out, and they want to max fund an IUL, now we might want to look at option A. If they're under age 50, almost always option B. You want that optimum flexibility. But you get somebody mid to later 50s, 60s, and we're doing IUL just starting out, you got to go option A. Really should think about that. Unless they got some money they're rolling over or a lump sum they're going to be putting into it. Then that changes a little bit. If you're not sure, run it both ways. Run an option A, run an option B. Now, this is also the preferred option, option A, when they stop paying premium. Remember, when premium stops going in and starts coming out, we go from B to A. So if we're not already at A, we switch to A when we stop paying. Why? Because the cost of insurance is based on the death benefit. If the death benefit's going up because we're adding on that cash accumulation every year, that means the cost of insurance is going to be going up. If they're getting older and they're not paying any more premium in, we don't want the cost of insurance going up. We want it leveled off or going down if we can, but leveled off at the worst. So as they get older, stop paying premiums, start making loans, switch it to option A. But for the majority of your clients, and I mean the majority, probably up through age 50 easily, look at option B is the way to go. Because IUL, when it started, I got in the industry in 1987, and Universal Life was relatively new. It had only been out a few years. The company I was with was a captive company. We had 4 whole life policies. They got very creative. We had 1 universal life policy. That's it. It's so brand new. It's called Adjustable Flexible Premium Life Insurance. And the key word there was adjustable, flexible. Whole life is not adjustable or flexible. You've got a fixed death benefit, you've got a fixed premium, and a fixed number of years you gotta pay it for. Universal life, I can increase, I can decrease, face amount, premium, a lot of flexibility. Option B gives you that flexibility because if I want to increase the premium down the road and I've got an option B death benefit, even if I'm starting out at maximum premium, I've still got some wiggle room to increase the premium because it'll just kick that death benefit out farther to make sure that I'm not gonna violate any of those corridors for TEFRA, TAMRA, and all those other complicated rules.
Can you switch A to B anytime?
You can switch from B to A anytime with no issue. You can't switch back or switch from A to B unless you get approved with underwriting, okay? So B to A anytime, A to B only with underwriting approval. So kind of like the blood types. BA, fine. AB, very rare. It is actually. AB negative, really. Is it O negative? Maybe O negative is the most rare one. Okay. Nobody else can answer this question, yes, but Anacle can. Can I reduce my face amount anytime? Okay, I'm not talking about face amount like in Washington DC. They change their face every day. I'm talking about the face amount on the policy. Okay, now, what happens when you change the face amount on a policy is that the company assesses surrender charges. Because you're doing a reduction in the face amount, they've got to remove some of the cash value so the policy doesn't turn into a mech. Well, Anaco, in its infinite wisdom, decided when we built the Signature IUL that we would build it with built-in safeguards and flexibility. And we would waive surrender penalties on face reductions. We are the only carrier I know that does that. So that means that your client, even in the first couple of years, when there's virtually no surrender value yet, or not much to speak of, they can still reduce the death benefit, because why? We don't charge surrender charges. There's no issue. So we allow them to do it. Now, the only caveat is that based on the original death benefit, we can never lower the premium, because usually when they're lowering the face amount, it's because they need to lower the premium. And they want to make sure the policy is still well funded. So anybody can lower the face amount, but if you don't lower the premium, you might have some issues with exceeding the MEC corridor. So bottom line is, if you start out with a policy, and let's say the policy is $500,000, and let's say that we're paying maximum premium, and we'll just say max premium is $500 a month. Okay, that's max. But if they did, and we don't ever want to sell minimum premium on an IUL, do we, right? Because if we just sell minimum premium, we're basically just covering the cost. We're never really going to have much left over to grow, we're just covering costs. So but let's say the minimum premium is $250 a month. Okay, that's minimum. Now, client, maybe a job change, maybe one of the spouses gets pregnant, probably the wife. Never really did, right? Five gals talk show on Fox or whatever, and I didn't think I heard it right, but one of the gals on there said, yeah, and my wife and I, and it's a gal, she's my wife, and I go, did she say my wife and I? So I can't keep up with that stuff. We got a couple of husbands down the bottom of our street, so that's okay, it's fine. Regardless, I'm getting off track. I do that a lot. It comes with age, and I'm a year older today, right? $250 is the minimum premium. So my client says, okay, something happened, I gotta lower the face amount to $250,000. I gotta cut it in half. Well, as long as I don't lower this premium any lower than $250, I'm fine. So I got a lot of leeway here. Mm. I can drop my premium in half too, and not. Yeah. I can't go lower than $250 because that's the minimum premium I started with. That's the only catch. But most companies, they say you can't do this unless you've got enough surrender value built up in the policy to cover the surrender charges we're going to assess you for doing a face reduction. Aneco didn't have that problem because we don't charge penalty.
What if they want to increase the price amount?
Then you apply for underwriting to get an approval on the increase. So, in many cases, it may not be an issue. If the policy's just got issued within the last couple of years, there hasn't been a noticeable change of health, and they don't want to go out and buy a new policy, they complete evidence of insurability, basically health questions. It's a separate form, a lot shorter than the brand new life application. And you're still gonna get paid brand new commission, just like you would on first year commission on a new policy. But it's a lot easier. And then the client has one policy. And just had an FEG agent do that on one, they were asking me last weekend at a meeting. They said, am I gonna get paid commission on it again? Because it just got approved. I said, yeah, you got paid first year commission. Now, the only catch is, if you're on annualization, you know, advances on your commission, you do get paid as earned on the increase. We don't have a way to do the advance on an increase. But you're still gonna get paid first year commission. So as that increased premium goes through on the new face amount, you'll get paid each month. Okay? Policy costs. I took this out of Broker's World, which is one of the big industry publications last summer, and they took the top IUL companies, the top six companies, or six or seven, top 7 IUL companies, they gave them letters instead of their names, by market share. And they did an illustration, male age 45, 20-year pay into an IUL, what is, and they took and added up all the policy charges, COIs, policy expenses, everything, for 20 years. And they divided that cumulative total of costs by the cash value. And they said, as a percentage of the cash value, what are the policy costs for each of these leaders in the IUL market? The best one on the block was 5%. Some of these were at 23%, 15%, 21%. My God, that's huge. 5% was the lowest, then you had 7. Here's Aneco. I did our own little, not the exact same case, 7%. So I gave us a smiley face. Aneco is one of the low-cost leaders. Why? Because we don't have some newfangled home-baked index. We don't use some other uncorrelated asset classes that are harder to hedge with options. Hence, the options are more expensive. Hence, the policy costs are more expensive. We stick to our knitting, S&P 500. One of the largest, most well-known indexes in the industry, and because of that, one of the most efficiently lowest cost pricing on the options or the hedging costs of any other index out there. That's why we use it. Well, that in it has about 500 companies covering small cap, large cap, domestic, international, you know, because a lot of their earnings come from overseas, very well diversified. So diversification, low cost, can't beat it. Okay, now we're going to finish on the IUL, so I'm not running too late, with some sales ideas. Okay, here's one, retirement. Now we talk about the loans and tax-free retirement, all sounds great, but one of the nice things about using the IUL instead of just relying on conventional retirement plans, and I'm not going to badmouth them, I got money in retirement plans myself, but I also got plenty of life insurance, because what good is my 401k if I'm not there to put money in it every year? If I'm not working for that company, or for that matter, if I'm not working at all, like if I'm dead. If I'm dead, I can't fund my retirement plan. My wife gets what's left at that point, my retirement plan, because Jeff's not there to put any more money away. So it's self-completing. I've created a survivorship benefit on my retirement plan by using IUL. Death benefits, or living benefits. Some statistics. Let's see, people age 65 in the workforce grew nearly 13% in the year 2000 to 18.8% in 2016. So the retiree category is growing, all right? Since 1878, that's going back to when Dow Jones, the index came out, right? A typical 60% stock, 40% bond, that's what they call a balanced. And when they talk about balanced fund or balanced mutual fund or balanced account, the old 60-40, okay? That did about 4%, okay? Why? Because you have a lot of down years. A lot of down years eats up a lot of up years, especially those shock drops like in 2008. Now this is really telling. I got this out of Barron's magazine. I get Barron's every Saturday, okay? Now, I don't home every Saturday to grab it, and my neighbor gets it, but it's a different story. I steal his Oregonian box. Okay, Morningstar warns that over the next 10 years, and this isn't me, this is from Barron's, like 2 months ago. Morningstar warns that over the next 10 years, a balanced U.S. stock and bond portfolio could generate, after inflation, roughly half a percentage point before fees and taxes. So if you thought 4% was bad, that's worse. And then you take out fees and taxes, ouch. IUL, they owe me out. Next bullet point. If future returns are as low as some market strategists expect, 401ks, traditional IRAs, stocks, bonds won't provide enough for the golden years. Get ready for alternative investments. We probably should change that. They said investments, we can't. Alternative options for saving and saving more and spending less. Alternative options, like indexed universal life, like indexed annuity, where I've got market exposure, but not market risk. I've got market gains, but not market losses. I've got tax efficiency, and I've also got living benefits. So, alternative options. And here's a great way we can use our IUL. Tell our clients that are maybe some of our older clients getting into an IUL in their 50s, and they're going to max fund it for the next 10, 15 years maybe. Tell them, hey, when you get up to that Social Security age, and yeah, you can start taking Social Security at age 62, but you know what? If we get this IUL cranked, maybe you got a lump sum to throw in, maybe you got a 1035 to bring over to kind of seed that policy and get it growing. In the next 10 to 15 years, what if you could just tap it for a few years, maybe the first 7 or 8 years after you hit age 62, tap it for income and don't take Social Security. Because every year you wait to take Social Security, your Social Security benefit goes up by nearly 7% or better. Over 8 years, that's 77% compounded return. That means the benefit they take at age 70 is going to be 77% higher for the rest of their life than the monthly benefit they would have locked in at 62. Yeah, you got to take things into consideration. Life expectancy, health, obviously, everybody's going to be different. Okay. Now, my wife, her family, my gosh, her grandma lived until she was 104. Okay. Now, both my parents, they were gone in their early 70s, so I figure I'm in my mid-50s now. I got about 20 more years of living hard, on the road, and then, we'll see. But, so it's the old buckets of money strategy. We got qualified plans. If they have qualified plans or get towards retirement, burn through those right away, because you don't want to die with a lot of qualified money in your estate, because that thing gets taxed 3 different ways a Sunday. So eat up that qualified plan. Okay, so that's one way to avoid taking Social Security. They got IRAs, they got old 401ks, TSAs, whatever, any of those. Okay, not TSA at the airport. Okay. Although they've been pretty nice. All right, and then IUL. So IUL and qualified plans for the first 8 years to defer Social Security. That's bucket number 1. Then we hit age 70, we go, okay, if I have any qualified plans left, I'm still going to keep that bucket flowing. I can go ahead and turn on Social Security, but I'm going to stop taking money out of my IUL maybe. Why? Unless I need it, I don't take it. let it build back up. I got my living benefits protection. But down the road, if things arise, maybe inflation kicks up, my health care is more expensive, whatever, I do need additional supplemental income, guess what? I got it, IUL. I go back into that bucket and just re-tap it again, because it's mine. So it's just a case of, I've just created multiple buckets to draw money out of for retiring. IUL can be a great supplement, or it can be a main bucket of income. Everybody's situation is going to be different. Okay, college funding. You know, we always talk about putting the policies on the little kiddies, but again, it comes down to what about the folks that are going to be paying the college bill, like I am right now. I got a freshman down at Oregon State. It'd be nice to have college paid for. Not every parent can set enough money aside in their 529s and whatever else, but you know, they get down the road. I'll tell you what, it'd be nice to have some money set aside and also have a protection plan. If one or both of the parents die or they live, college is paid for. Death benefit, living benefits. I got that contingency taken care of. I have extra funds set aside in case I need it for emergencies. Or, and you know, Alex, that's my son, his college tuition at Oregon State, as an Oregon resident, I think it came to about 20, before scholarships and all that, kids are brain. But before scholarships, it's about 26,000, I think, for in-state. And then books, just the first term, and now we're in the second term, they got one more after that. I think we've already dropped about $5K easy on books. Before it's all said and done, we'll probably drop 10 the first year. So nearly a third of the tuition costs in books and incidentals. So if I can have a cash value in my IUL that I can pay for, you know, a third or a fourth of his college expenses each year on an as-going basis, kind of nice. And if I die too soon, I know that, hey, college is paid for, and graduate school for that matter. So the IUL can, and then I have money left over in retirement, I tap that bucket. So it can be a multifaceted plan, and you're not going to get that with a 529 plan. Now, if they have a 529 or a UGMA account or some other college savings program, I'm not saying to go in there and say, stop doing what you're doing. You know, kill your 401k, kill your college. No, clients don't like to be told they did something wrong, because then they're going to be less receptive to what solution you have, because then they think you've got an ulterior motive. So tell them, you know what? I think what you've been doing is fantastic. But if you die tomorrow, or you have a catastrophic illness and you can't work anymore, you're not going to be able to keep putting money in at the same pace into that retirement plan or that college savings plan. So let me supplement your good decision already in place. Let me supplement that. Let me ensure that good decision. Let me make sure that that you can see that through. IUL can supplement what you're doing and protect what you're doing. And that's when you go into the benefits of IUL. And you're going to have a much more receptive client. So this can be a retirement supplement. This could be a college savings supplement plan. And some of the benefits of IUL, 10% penalty if a 529 plan is not used for the school. We're comparing IUL and the 529. I've got a 529 for Alex. If there's money left over, I'm not too worried there will be though. Boy, he's going through it. But if there's money left over and the wife and I decide, you know what, we're going to buy that property on the Oregon coast, guess what? Uncle Sam's going to say, you can buy it, but 10% of whatever the value that's in that plan that you take out, plus income tax on that, then you can have what's left. We don't have that with the IUL. Self-completing funding. If I die tomorrow, nobody's there to put money in the 529 plan. Hence, I compliment their good decision on having a plan by adding to it with the IUL. So if you're looking at increasing your 529 savings, maybe divert that increase into the IUL. Countable asset of parent or a child for FAFSA? No. Financial, whatever, basically financial aid. I had to sit through that boring 1.5 hour FAFSA thing. But the guys that were giving it were talking about annuities and life insurance, the two assets that are not countable assets. whether it's in the parent's name or the child's name. So another reason to not have all their eggs in one basket when they're saving for college. Because if they do need to have access to some of that financial aid, if they have too much set aside in that FASBA account, they're gonna lower their amount that they can qualify for, in any financial aid. So, sales idea. Grandparents wanna help out for their grandkids' college. Great idea. Don't stick the money in their 529 plan. Buy an IUL plan on their parents, okay? And plus, they can put more money into the plan because it's in the parent's name. If they want to put insurance policies on the kids, that's fine. But make sure that the goose, basically the parents, are insured. Have the grandparents put the money into policies on their kids. And then their kids can make sure that their kids go to college. So, and if they have a large lump sum, and they can't stick, maybe they got 100,000 they want to drop in. Well, you can't drop $100,000 dead center right into an IUL. You're going to force the death benefit too high, and it won't work. So how do we do it? Utilize an immediate annuity, or possibly even an Asia Plus, if they're not going to need take all the funds right away. Asia Plus or a SPIA. And then sift the money from that annuity, one of those two annuities, into the IUL over the next 10, 15, 20 years. Okay? So basically, if we looked at a SPIA, and let's say we got grandparents and they want to do a $200,000 drop-in into the 529 plan. The parents say, we don't really have enough insurance in place. We want to make sure the kids go to college. If we do it this way, and the grandparents could own the policy. If they've got an insurable interest here, they could own the policy. But I won't get too granular on that. Let's just look at the concept. SPIA, grandparents, $200,000 gift. 20-year annual IUL premium, $12,000. That buys a $350,000 base IUL on the father, a $250,000 term rider on the mom. We're going to assume that dad is the breadwinner in this case, but it could be reversed, could be the other way around, okay? And we're gonna go ahead and put a $10,000 CTR, okay, child term rider that covers all the kids. Why? Because at age 25, those kids can convert their $10,000 of Aneco term to a $50,000 Aneco, any policy I want, any permanent policy I want. They get their starter policy right there when they're 25. Hopefully by 25 they're out of college. My old roommate barely got out at 25. I was long gone out. I was married by then. $132,000 cash value in 10 years. $245,000 cash value in 15 years. Kids are getting ready to go to college. I got over 100 grand. I got over 200 grand. I got some money for some books. I got some money for some tuition. Thanks, Grandma and Granddad. So instead of just giving them fat Christmas presents and 529 contributions, talk to Grandma and talk to them about, hey, maybe you want to take care of your grandkids. Here's a good way to do it, and take care of your kids at the same time. Okay? Parents never get tired, shouldn't get tired to take care of their kids. Now, I can say that now because Alex is only 18. Maybe in another 10 years when he's 28, I'll feel the same, but I probably will. He's a good kid. Key benefits and riders. Let's skip through this a little bit. We got the child's term rider I just talked about. Convertible up to $50,000 max, or 5 times the term rider amount at age 25. Okay. You can blend term, 10, 15, and 20-year term on the IUL. So if they can't buy all the IUL, all the coverage they need in the IUL and effectively max fund it, and they need more coverage, you can always blend some term in with that IUL. Still one policy. Still fully convertible like a standalone term policy. Full commission, conversion credits, a whole shoot match. Okay? Match. Disability waiver, and of course, living benefits. Okay, living benefits. Let's get over to that because we're running late, so I'm gonna. Whoops, went too far. All three living benefits, you know that, you know the story, critical, chronic, and terminal illness, best in the business, 2 million, lump sum, and we pay. And we really pay the last 2 years. 2006, 3 years actually, 2016 through October of 2018, we paid over 12 million in living benefit claims. Over 12 million. Okay. Good stat, good stat. 113 claims in the last nearly 3 years, over 12 million. Now, make sure you don't miss these contests. How many are going to try to go to Red Rock? I know F&G is trying to promise you do 8 apps and all that.
Here's the contract.
Anaco says, phooey, right?
Phooey.
Say
Phooey.
5 apps. Well, I do say phooey. 5 apps, not 8. 5 apps at 10,000 a premium will give you 250. Now, knowing what the room cost is at Red Rock, if you got 600, that's 2 nights, based on the room rate FEG's getting. So you do 20,000 a premium and 5 apps, your room's covered. You want to do some gambling? I've seen some of the guys back there at the craps table.
Yeah.
Blackjack.
More.
I've seen it for a couple years. So Joel's going to need to be up here somewhere. Me, if I played, I'd have to be up here because I need the extra. All right, because I'm going to lose half of it right off the shoot. But no, seriously, through April 30th, started January 1 through April 30th, e-app, paper app, doesn't matter. E-app's better, it's faster. Get yourself some extra cash, cover yourself at Red Rock. But if you want to get even more cash than that, and you don't want to do 5 policies, how about 3? Now where's Tina?
Right here.
Okay, Tina, all I need is 2 more apps.
It's
It can be the minimum premium at this point, 5,000, 10,000, because you're already at the million. But, you do 2 more apps, you're gonna get a $1,500 bonus.
It's already pending in there.
Party in Tina's room.
It's already pending those 2. I have 3 actually.
Okay.
Really?
Right
So
there.
she's
I didn't
confirmed.
see it.
Party will be in her room.
All right. 1,800. Party.
Seriously,
Yeah,
3
Oh, I didn't
apps
see it.
for basically $500,000
party
to
sheet
$750,000 in an annuity, and it's not tough with annuity money.
You don't share?
$500,000 to $750,000, you get a $750 bonus. There's your room and board right there for 2 nights.
With 1,500.
Then you go to the craps table, pick up your $1,000 bonus, 750,001 to $1 million,
Joe.
and then at $1 million plus, you're at the max. So 2 ways to get extra cash between now and April 30th. And notice we timed it just right because the contest ends April 30th. Checks will all go out by May. Red Rock's in June. You're all set.
Perfect.
You're all set. Okay. New life application, you probably already know if you're using the e-app, it's transparent, you're already using the new app. If you're, I still use paper, I still read paper books, paperbacks, but the paper app has changed. Make sure you're using the current app. It's what's on our website now if you're ordering apps. Expert app for annuities. Okay, expert app for annuities. 4th quarter 2019, fourth quarter, September 2019. Same thing for the flexible premium Asia Plus. Okay, we're refiling the Asia Plus. We're not going to pull the current Asia Plus till we have this approved. We're refiling the Asia Plus as it is by merely adding a flex pay option. No other changes. 4th quarter, that's coming. Okay? Signature index IUL upgrades. Those are coming in the 1st quarter of next year. So we got some time yet, but those are coming. It's going to involve some new strategies. Okay? I don't even have all the details yet. It's going to have the new CSO table. They keep telling us we're living longer and longer. Well, maybe I like that. And they can tax us longer and longer. Okay? That's why we need the IUL. New indexing strategies, lower cost, probably some other bells and whistles. Okay? E-policy delivery. I don't have an actual date yet, but it is next year. E-policy delivery. That'll be for life and annuity. So imagine this. We do I mean, I was reading on the plane coming out here, millennials are the one group that just, they're everything. That's 18 to 40. Okay, 18 to 40. And they break it into two halves. The 18 to 25, they live in their phone, they live in their iPad, a lot of them live in their car, or their parents' basements. Okay. But bottom line is they love E, so we're going totally E into 2020. So Anaco is really cooking. And it's good that we're cooking. Because Joel, you're entertaining, but I saw you at that restaurant last summer. And don't ask him to fix the eggs. I mean, he just made a mess of it all over. But that was fun. We went out one of the nights at down in Mexico and to one of those grills, those Kabayashi grills. And he and Neil both got to do some cooking. And Neil made a few extra flips. Joel got a couple of good flips, but then his eggs went belly up. So we had scrambled eggs for dinner, thanks to Joel. All right, thank you for letting me spend my birthday with you.
Happy birthday to you. Thank you.